So now I would like to switch gears a little bit to PCAOB away from the SEC. PCAOB, of course, stands for Public Companies Accounting Oversight Board, which is the agency, which is, I would say, quasi-governmental or semi-private agency, which is subservient to the SEC's oversight, responsible for ensuring audit quality of uh, public company audits in the United States. I mentioned when I was at the commission for the first time, I was in the group that was actually responsible for the oversight of PCAOB. PCAOB board is appointed by the commission, and its budget is subject to commission's approval, and all of its um, standards have to be approved by the commission. The main, of course, mission of PCAOB is to inspect audit firms, audits, and provide, essentially feedback on whether there are any observable, noticeable audit deficiencies in those audits. So, just to give you a bit of a background, in the end of last year, 2018, PCAOB board, in a very unusual move, was fully replaced by the SEC. That was in response to, as it's now very clear, to document stealing scandal, which I mentioned earlier, where two former employees of PCAOB facilitated the transfer of confidential client inspection data about future inspections to KPMG to enable them to essentially be prepared for better prepared for those inspections. That was a huge embarrassment to PCAOB because it highlighted a breakdown in their own organizational culture, I would say, in their own internal controls. And it obviously made the commission very unhappy. And in a fairly unusual move, PCAOB board members are typically appointed in staggered terms. Not only did it replace the board members whose terms have expired, and that was 3 of them, but also they didn't reappoint other board members who usually are fairly typically routinely reappointed. The new board is kind of a little bit unusual in its composition. Unlike previous boards where you saw people predominantly either former CPAs, which is still the case for a couple of them, but for example, the previous chairman of PCAOB, James Doty, was former chief counsel of the SEC. So they came from financial regulatory backgrounds typically. This board is heavily represented and led by people from the political side. The current chairman is a former senior staffer, Republican senior staffer, and the most recently appointed board member was also a senior Republican staffer. They have a couple of accountants just like before. And there was something very interesting. One of the newly appointed members was Kathleen Ham, which was actually a good choice in my mind. She was a technology expert, an IT expert with IT executive background, and she was appointed to fill in somebody else's unexpired term. Everybody's expectation was she'd continue in her own term, and she was actually replaced one more time after 1 year with essentially somebody with completely a political background, very little finance background or accounting background, if any. The rumor on the street is that Kathleen Ham was perhaps viewed as kind of a more of an independent voice. But that, of course, is very subjective. Anyway, PCAOB is being kind of this whole year, I would say, has been in a state of enforced silence, if you will. they have a new strategic plan that they've adopted in part in response to this whole scandal, I would say. They've been very heavily criticized in the media. I would say this is not, this has not been good for them. And late last year, somebody noticed that in the proposed, or early this year, in the proposed long-term budget of the Trump administration, the plan is to, if they stay in power, to actually liquidate PCAOB over about 3-4 years and roll it into the SEC. So Arthur Levitt, who is the former SEC chairman in the late 1990s, wrote, an Wall Street Journal op-ed, which I'm showing here, which was very critical of this proposed move. Remember, PCAOB was very much established in the wake of Enron scandal to kind of deal with a lot of bad audit quality problems. But it's not been a popular agency among audit firms by any means of imagination. And many of its rulemaking activities, under Chairman Doty in particular, were viewed as less having to do with audit quality, but rather more kind of showing that, with showing greater auditor accountability. Such would be, for example, the auditor partner transparency rule, which requires now disclosure of audit partner names alongside of any material involvement of other auditors. And so, they are kind of in this interesting time right now. Interestingly, they're required by statute to have a public meeting, and they had one for about 30 minutes last year. There haven't been any meetings of Standing Advisory Group, which is this important body that advises them from the outside. So it's hard, there's been a lot of turnover of senior staffers. Pretty much all of the, which is part of, I guess, the house cleaning after the old board was essentially terminated. And all of that kind of spilled out in the press. So, right now maybe that silence has to do something with that kind of damage control. So that's the broad picture with PCAOB, kind of what's been going on with them. Now, in most recent development, they came out with a new format of the inspection report, which I kind of like, actually, and I'll show it to you in a minute. It's certainly much more user-friendly or pleasant to look at than the previous one. Here's what they summarized the changes. It streamlines the content to enhance readability, and I fully agree with that. It's a much more pleasant document to look at than before. Utilizes new charts and graphs to make information more digestible and accessible. I agree with that as well. Reduces the amount of technical boilerplate language. Yes, the previous report, which is actually kind of a problem with most of the documents that the regulatory agencies put out, was a lot of boilerplate stuff. And it gives a lot of interesting statistics. So I actually went on and looked at one. I looked at a couple. They had the first batch of them made available, and even though they're available now, they relate to 2018 inspections. And you see one of the nice things about it is that there's a lot of nice graphs there, and you get a sense truly of what's going on. So here I picked on PwC randomly, not because I haven't been against them or anything. See here, for example, it's pretty clear in 2018 they inspected 55 engagements, of which 14 had deficiencies, which is nice. That ends up being what a deficiencies rate of about slightly, maybe about 12-13%. I'm sorry, about 20%. I'm sorry, I can't do math. It's 25%. I actually went and recalculated it. Which sounds like a horribly high number, but actually by historical standards, it's not high. in part what precipitated the KPMG stealing of the documents scandal, stealing of the inspection scandal, is that their inspection, find negative deficiency rates were much higher than that. As far as even early 2010s, for certain types of firms, you see inspection rates, negative inspection rates of close to 40, maybe even 50%. This was very controversial at the time because firms really reacted. It seemed that they said this is not reflective of the true state of audit quality. PCAOB is kind of just showing its regulatory teeth and so on. So 25%, in fact, is not bad historically. Considerably less than previously. The other chart tells us nicely what was kind of the breakdown of by the audit type, and most of them, 10 out of 14, are the integrated audits of ICFR and financial statements. Only 3 just in financial statements, and 1 just ICFR, which is not a surprise. So another thing what I like about it is it gives us a sense of the dynamic again. Of the breakdown. So PCAOB has started some time ago. I'm not exactly sure when, but would say probably within the last 5 years. Not just historically they would select audits for inspection on the basis of risk. They would be more likely to go after audits after clients where the problems be more likely to be present. They've gotten a lot of criticism over doing that because it's again it doesn't tell you what true state of audit quality is. So they've augmented with some random selections of clients, which is nice, and it tells us now that they did 45 risk-based selections and 10 random selections. The number of audits they've reviewed have been fairly stable, with 55 in the last 2 years, in 18 and 17, and 56 and 16. And most of those audits were integrated audits. For some reason, a little fewer in 2018, which is not a surprise because what's called GNF firms, the global national global network firms, which PwC is one. They typically do a lot of integrated audits. So here's some information that we learn about ICFR audits. ICFR, of course, stands for Internal Control of Financial Reporting. Again, gives us a breakdown that most of the deficiencies affected both. And that shows that it's fairly consistent between 2017 and 2016. So what are the type of deficiencies that they observe? What's the breakdown of deficiencies in the audits of financial statements? Did not sufficiently evaluate significant assumptions or data the issuer used in developing the estimate is a prevailing one. That's historically been the case of most firms. One of the areas PCAOB hammers on is the audits of estimates, where evaluation of assumptions is one of the key elements. And it's not used by any means of imagination. Insufficient substantive test would be another one. So nothing surprising here. What's the breakdown by area in terms of the deficiencies versus number of audits reviewed? So most of the deficiencies in this breakdown are in the area of revenue. It's not surprising at all. That's historically been the case. Again, so revenue is a critical account. So you see loans and related accounts. Another one with a lot of assumptions. Business combinations, lots of area of complexity. So nothing really surprising here. They're very consistent in what they do and how they approach it. So let's move out of inspections now. Talk about a little bit about the enforcement. PCAOB has its own enforcement group, modeled similarly to enforcement division of the commission. Now, so oftentimes, I, for example, until I actually went to work at the commission, didn't understand what's the difference between PCAOB enforcement and ACC enforcement. So the first biggest difference is that the ACC enforcement is not just focused on auditors. PCAOB enforcement is strictly about auditors of public companies. ACC enforcement has to do with enforcement of all aspects of securities laws. Accounting and auditing is one of many components. So insider trading, market manipulation, disclosure violations, things like what Elon Musk have done, on Twitter and so on. That all falls under the ACC. So types of enforcement cases that we saw, a financial advisor enforcement, so on. Much broader menu. And like we said earlier, ACC's enforcement priorities changes with administration, essentially, with the type of commission and power. PCAOB, though, is very, narrow in its enforcement orientation, I would say. That's audits of public companies only, and typically they go after independence violations, which would be also within the purview of the ACC. They go after egregious violations of auditing standards, and here I'm not talking about just deficiency findings. I'm talking about situations where there's egregious disregard for due care. That's what typically causes an enforcement action. And those are the two big ones that they go after. So the number of, think about it. They do, if there's big four audit firms, each one of their 55, something engagements they inspect. They probably do, I don't know, 300-400 inspections a year, and the number of enforcement actions that they issue is comparatively much smaller. So you can see here, they had 30 settled disciplinary actions, 19 sanctioned firms, 27 individuals. So much small. And here, again, audit deficiencies is not, only very egregious audit deficiencies. When it turns out that the auditor basically failed to do their job or did something just that amounts to violation of securities laws, not the mere criticism of their work or what the deficiency is. Inspection deficiencies, that gives rise to an enforcement action. Now, an interesting question arises, because auditing violations are also within the purview of the SEC, how does it work? How do they work together? And there's a degree of duplication here, no questions asked. PCAOB typically, they oftentimes will go after the same people, but the type of penalties they can impose would be slightly different. PCAOB could deregister the audit firm. They could impose, essentially disbar the auditor from being an auditor of a public company. ACC's penalties are different. They can impose, as you may know, a 102E action, which is essentially a permanent or semi-permanent bar from working as an accountant for a public company, which is a much more severe type of a penalty. In the extreme cases, SEC will work with the Department of Justice in terms of potentially pursuing criminal penalties, which of course SEC cannot do, but they would essentially work with DOJ to put somebody to jail. PCAOB has none of that. But in this very small niche, there is a degree of duplication of duties, and I would say that SEC's award ultimately carries much more power because PCAOB has to report to them. Now, it's interesting that this whole issue of duplication of duties was highlighted somewhat in the last congressional hearings when once a year the chairman of PCAOB and other agencies have to testify. And so, in particular, it bothers the Republicans on the Hill that PCAOB is doing this a duplication. We need to cut our regulatory costs. Why do we have two agencies doing the same thing? And of course, the amount, comparatively speaking, the amount of enforcement work SEC does is much, much broader than PCAOB. And in many ways, SEC has the final word probably anyway in terms of imposing sanctions. So that kind of underlies this, what I started with, that why would you think about Trump administration, if they stay in power, would want to get rid of PCAOB entirely? Well, because, they want to show that they cut regulatory costs, and there is like a little bit of duplication. Probably in the grand scheme of things, pretty minor. So what are some of the notable enforcement actions that PCAOB had pursued? So PCAOB here sanctioned Deloitte Korea for violations of quality control standards, altering audit documentation, anticipation of PCAOB inspection. That, of course, is not allowed. Once the audit is done after a fairly brief period of time, working papers can no longer be altered, and particularly they cannot be altered if you know that if you get a notice from PCAOB that you're going to, a particular audit is inspected. And here was an example of egregious violation of that. Markham was sanctioned for independence violations. That's an interesting one. In this case, firm advocated for its audit clients essentially as an investment opportunities in connection with the firm's annual investor conference. Right, so we all like to be, as an accountant, viewed as adding value to the clients, and here the firm sponsored an investor conference, and you can't do that. I mean, you have to be impartial and independent. You can't promote your clients. PwC Mexico violated independence requirements because of prohibited loans by partners with one of the banking clients, and didn't notify the client about the independence violations in a timely fashion. So that's fairly common historically, has happened before. Here's an interesting one. William Turner, CPA, the board sanctioned an engagement partner who improperly determined in the face of contrary evidence that an issuer's deficiencies in ICFR were mitigated by other controls. So PCAOB is very explicit in their standards that if you reach a conclusion against what evidence says, you need to pretty convincingly document why you ignore contrarian evidence. In this case, obviously, this person in their mind didn't do that, or just ignored kind of red flags, and that would be one situation when the blatant ignorance or ignoring of red flags could you end up being subject to sanctions. Here's a sanction against engagement quality reviewer for failure to evaluate adequately the engagement team's audit work with respect to significant risk areas, such as the allowance for loan losses. So allowance of loan losses is, for banks in particular, has been a very key area of attention. It's one of those areas where there's always audit deficiencies. That's what got the KPMG into trouble in particular. They had a lot of problems and deficiencies with the ALL testing, so in banks. And here again, what's interesting about this is the action is not against people who audited, but against the quality control partner who failed to do his work in critically evaluating what people have done in terms of the audit. We're going to switch out a little bit away from, I would say, from enforcement, talk a little bit about kind of politics. As you know, PCAOB for decades, I should say, since it's almost its founding, PCAOB is going to be 20 years old in 2023, has attempted to inspect Chinese audits. Audits of Chinese companies cross-listed in the United States. Chinese government is the only government, either the only one or one of the two governments head of They explicitly refuse PCAOB's ability to do so. This year, and this is very, very recent, we had a very high-profile fraud among Chinese issuers and Luckin Coffee. Interestingly enough, I've never heard about them until last year when I teach financial statement analysis class, and one of my students, who was obviously very much likes the subject, comes up to me and says, "Did you hear about Luckin Coffee? This is going to kill Starbucks. This is so cool." I'm like, "I've never heard of them. It's interesting. Okay, I went to look into this." Well, it's been what, maybe 10 months since, or 8 months since that we find out that they very significantly cooked their books. So, of course, preceding that was the problem with the Chinese SAROs and reverse mergers, RTOs, and where they were abusing the loophole and essentially bypassing the registration requirements here in the U.S., defrauding U.S. investors and so on. So essentially, last year, SEC has had enough. They've issued a series of statements essentially saying that invest in Chinese stocks at your own peril. The most recent one is April 21, 2020. It's a joint statement by, in this case, SEC, but the and PCAOB, and obviously PCC people are very heavily represented here, all the big guns, starting with the chairman, the chief accountant, the director of CorpFin, the director of investment management. Essentially, they're saying we can because PCAOB cannot go down there and cannot look at the working papers. We cannot, we can no longer have faith in the stocks. Now, of course, you may have read in the Wall Street Journal that this is accompanied by this Luckin Coffee fraud that I mentioned. And delisting of Luckin Coffee from NASDAQ, essentially there is a legislation in Congress right now that basically says, Congress very rarely interferes in what PCAOB do, but they're saying, okay, if China doesn't give PCAOB permission to inspect audit firms, we will delist Chinese stocks, and they will not be able to raise capital in the United States. It's pretty extreme. One would argue that it's probably very much connected to the whole geopolitical situation with China right now. But it's interesting, you don't tend to think of PCAOB as being this highly important agency in the realm of agencies in the United States, and yet here we go, very much in the center of geopolitical controversies that we're dealing with right now. Just wanted to mention it to you. Another area where PCAOB has been rather active was in terms of role of technology. They have what's called a research project, kind of trying to understand how data analytics techniques and the artificial intelligence techniques are being used in the audits. And so they finally came out kind of with their, I don't know what to call it, sort of an observational document about how technology is used. And essentially, I would say that they're saying they're kind of right, use technology. Technology is great, but don't do so blindly. Use your judgment and so on. So I guess they're still in a stage where they're trying to figure out if any rulemaking is necessary, and we can talk about that if you'd like. But so since they've been looking at this now for several years, I would say at least 3-4 years, it's been on their research agenda. I think they felt compelled to come out with something to talk about. The other document which they released recently, which I think is kind of important, is quality control standards exposure draft concept release. They're going to write a new quality control standards, kind of underline the importance of the tone on the top, organizational culture, internal controls within the audit firm to make sure that the audits meet standards. And very much in line with the International Auditing and Assurance Standards Board, like CQM1 standard. I think they want to be on the same page with them. What are the specific elements? So here's the list: firm assessment, role of firm governance and leadership, firm risk assessment, the relevant ethical requirements, acceptance and continuous of clients and engagements, engagement performance, and so on. So that's kind of a broad focus on that. So not exactly sure myself why they feel compelled to do it. What exactly is the concern with the existing quality control standards? Maybe because they were one of those grandfathered in standards from the AICPA, they feel the world has changed. Maybe they're not clear enough, but that didn't come clear to me. What is the push for that? They've been talking about adopting this new standard or developing this new standard for a while, and so I guess in their mind there are some inefficiencies or problems that this will help solve.